Hey everyone, hope everything is going well. Uh, I rarely do podcasts on this new channel, AIH Finance, but I'm going to bring on an old guest who used to come on my old program and is also a friend of John Manfreda, who's been on my podcast before. Jordan, thanks for coming on from the Daily Gold.
Hey, Rahul. Thanks so much for having me. It's great to be back with you.
All right, where do we begin? So I was watching one of your videos from the last week, and you seem really excited, and you seem to be quite bullish. And yeah, someone may say that, okay, you run a newsletter at the Daily Gold, but why are you bullish right now on this precious metal space?
Well, I would quickly say, like, what time frame are we exactly talking about? Are we talking about the next 12 months or the next 6 months or the next 3 or 5 years?
Um, I would say the next few years.
Okay, well, yeah, there's several reasons. I think well, not I think. I know that technically gold earlier this year, it finally broke out of a 13-year cup and handle pattern and something that I was looking at 2, 3 years ago, even back in 2020, when we got that rally or the Fed cut rates in 2019, and then gold was able to break above 1375, where it was stuck in there between 2013 to 2019. And then when it broke out at that point, uh, gold, the next major resistance would be around 1900, the 2011 high. And so even at that point, I was thinking, well, it's probably going to run up and it'll stop at 1900. And then, well, we have this big cup. And so even back then, 5 years ago, I was thinking this is setting up like a cup and handle. And gold, as we know, it peaked not long after, but it went all the way up to about 2070. And then it took 3.5 years or so until it broke out of the handle. So it was building this handle that lasted much longer than most people thought, and longer than I thought. I thought, the handle will probably be at a minimum a year and a half, probably 2 to 3 years. And so it turns out is about 3.5 years. But the thing about the pattern, there's a couple of things to note. Gold was slow, or the cup was sloping up like that, where you had the right side, you had this higher high compared to the left side. So that was an indication of strength in the pattern, because normally in a cup and handle, the first peak and then you form the second peak on the cup. Normally the two peaks are around the same level. Sometimes the peak the second time, if you're looking at the chart, it's on the right side. We call it the right peak. Sometimes the right peak is a little bit lower than the left peak, and so that would indicate not a weak pattern, but it's not as strong as the typical pattern. So because the right side made a slightly higher high, and at the same time as gold, the handle was being built and the market consolidated for 3 years, gold was holding above the 38% retracement from its bottom. I want to say 20. I'd have to go back and look at it. I know we have some charts that we're going to show, but basically, gold, other than like a few weeks during that 3 year period, gold was holding above the 38% retracement the entire time. So the pattern was setting up very, very bullishly in a big picture sense. And I kept saying this in 21 and 22 and 23. But at the same time, I kept saying, well, this doesn't mean it's going to explode right now. It doesn't mean that it's going to break out, this month or next month. But the way that it was set up, it's a super bullish pattern. And so we have this breakout earlier this year above 2100. So the measured upside target is around 3000. But if you take the log target, which is actually the percentage target, so you're looking at the depth of the cup as a percentage, which is around 100%. And you project that forward, that gives you a log target. I mean, depending on how you measure it, it's anywhere from about 3,800 to 4,100. And so all the historical cup and handles that I studied, there's not that many, but all of the ones I studied, they typically went from the measured upside target to then the log target within 6 to 12 months. So if gold hits 3,000, like let's just say early next year, then it could potentially go to 4,000 based on history in 6 to 12 months after hitting 3,000. So the technical arguments, just looking at looking at the technicals, and by the way, I mean a 13-year cup and handle pattern, that is a hugely significant breakout. I mean, if we look at the S&P 500, it wasn't a perfect conventional cup and handle pattern, but it did break out of a cup and handle pattern in 1950, and had this huge run after that, as we know, for 15 plus years. And there's a couple other examples that escape me right now, but to have that kind of a breakout from a 13-year pattern, that signals that gold is going to be a very strong market, not just for a couple years, but 4, 5, 6, 7 years, something like that. Now, the other factor is that, and this has been interesting. So the S&P, the stock market, is still in a secular bull market. And if we look historically, when did the S&P lose its secular bull markets in the past? And for me, that's when it fell below the 40-month moving average and stayed below it. And so that happened 68, 69, and then also in 2000, 2001. And so those were the points when gold started. It began a new secular bull market. So we haven't even seen that happen yet. So I think that, and I'm very confident that whenever we see that happen to the stock market, that's going to set up, okay, gold is going into a new real bull market now. And one of the ways I look at that is I have this chart, which I sent you a couple of charts, which is I calculated a 60-40 portfolio, based on historical data. So this is a conventional investment portfolio, which conventional investment advisors and finance people tell you to have, basically. So this is 60% stocks, the S&P, 40% bonds. It's from the 10-year Treasury. So I had this constructed for me, and this is total return. This is just looking at the prices. This includes the dividends from bonds and stocks. I have this data going back 100 years, but this is a really good indicator for gold, and we can see that the bull markets in gold, the secular bulls, really accelerated when gold broke out. When it broke, the ratio there, you can see gold divided by the 60-40 portfolio. When that ratio broke out and really started moving up, that is when the secular bull market in gold was really confirmed, and for precious metals as well. So we have not got that signal yet. We're very close, and we could get it in the next couple months. So we have this really bullish setup in gold technically, but at the same time, we haven't even got this not new, we haven't got this signal, which for me, this is what confirms a new secular bull market. Because when gold is in a secular bull market, conventional assets have to be in a secular bear market. And what's really interesting is, I see a setup a lot more similar to the 1970s and the 2000s. So what's really interesting is bonds in 1965, they fell into a secular bear market. And what stocks did not fall into a secular bear until 68, 69. And so where we are here and now, well, I don't have that chart handy, but based on my calculation, bonds fell into a secular bear, I think, after 2020. And so if we see in the next, whether it's the next couple months or the next year or two, if we get the stock market falling into a secular bear, then you're going to have stocks and bonds in a secular bear. That's what we had in the 1970s. In the 2000s, bonds were still in a secular bull. Stocks were in a secular bear. But we're setting up for something that I think in precious metals could be really, really historic over the next 10 years. What we've seen in recent months is just the start of it. So, those are the big picture technical reasons. Fundamentally, I think the issue is we're going to have to see a lot of money printing to pay for, fund the government. The interest on the debt is really, really starting to skyrocket. I think in the last several months or the last year or so. So at this point, looking at these things, it's really unavoidable. that that to me that we're going to see a lot of inflation moving forward, and bull markets and precious metals and also commodities as a whole. But to me, here and now, I think gold is in a real sweet spot right now.
Yeah, you've made a lot of decent points. I don't know if you remember that I follow mainly the fundamentals compared to the technicals. That's your expertise. And I look at the 10-year tips yield. I don't know if you look at it in terms of your analysis. Maybe I'll
I
show
do,
you.
I do,
Oh, you
I
do?
do.
Okay. So
Yeah, I'm
maybe,
actually, I'll just cut in for
yeah,
a few
yeah,
seconds, but
yeah, for sure.
I'm
Yeah.
actually, yeah, I'm updating, I'm writing a new book, I'm updating my old book, and I think PIMCO did a study years ago, and the real tips 10-year yield, they found that that was actually the best fundamental indicator for gold.
Yeah. Yep, I'm not surprised about that. And I'm just looking at uh the data right now. I don't know if you could see it. But
Yes,
okay, so if you see October of last year, the 10-year tips was 2.44, and I thought gold held really well. I think gold was trading between 1800 and 1900 at that time frame, and it didn't go down while the dollar was a little stronger than where it is right now, from my knowledge. And then the yields, the 10-year yield went down over the past year or so. And then you saw the 10-year tips at 1.58. And what did you see? You saw gold prices go up, silver's somewhat, and some of these miners that you follow very closely. I follow like the high beta miners, like they've been doing pretty well. And even if you look at from October 2022. So this is what I look at. So you're looking at technicals, you're bullish on that, and I'm looking at on this end.
I remember, and I mean, I'm editing my book, and I wrote the first chapter like a year ago, so I have to kind of edit it. But I remember making the point in the book that at major turning points, gold actually leads real interest rates. So at major turning points, because if you go back, you can see that chart. Look where the real interest rate bottomed. I mean, gold peaked. Um, it's hard to see maybe, but you can see the bottom was actually in 2021. So gold peaked and started declining uh, before you get the signal from real interest rates. But we saw the same thing on the other side. To your point, gold was holding up really well when real interest rates were rising. The Fed was hiking. I mean, gold held up really well. It was. I also was making that point at the time. Like this is the second biggest Fed hiking cycle ever. And gold, I mean, it's painful at the time when you're in there week to week and you're looking at it and the stocks aren't moving and gold isn't doing much and silver's really weak. But like from a 30,000 foot view, the point was gold is holding up really well. Like this is all of this stuff is bad news for gold, and it's holding up. Yes, it corrected. It was building the handle, it consolidated, but gold was holding up really well based on that. So the larger point is gold. Completely agree with you on that indicator, but gold at major turning points, gold leads that, and that's why we saw gold bottom and move. Um, I think before the 10-year real yield started coming down, but to get to your other questions about the stocks, there's a couple reasons I think why the stocks have really underperformed gold, or maybe two or three. But the first thing um, is mining margins because of inflation and the cost inflation that we had from 2020 to 2023, or from 20 to 22 in that period. You had some serious cost inflation. So even though gold a couple times when it was building the handle, it rallied back to 2000 or 2050 or whatever it was. Uh, the real price of gold, like if you're talking about gold versus its costs or gold versus other assets, the real price of gold was coming down. And so gold, the gold stocks follow mining margins. They don't follow gold. And so now they follow mining margins now, but the gold price or silver price, that's a huge, I mean, that's, a huge part of mining margins, obviously, but the other side of it is costs. And one thing I discovered is, again, from a bird's eye view, if you look at the inflation adjusted gold price, it actually correlates like really well historically, again, from a bird's eye view, but it correlates really well historically to the pattern, the price pattern of these mining stock indices. And so it makes sense because you're basically looking at the gold price and then you're using inflation as a proxy for mining costs. So, but if you look at the inflation adjusted gold price from 2020 to, I think 2022 or even 2023, the inflation adjusted gold price was down like, I think 25% while gold was building the handle. So gold was holding up really well, but in real terms, the costs were just killing the miners. So that's a big thing. Another big issue, if we're going back farther, is actually the introduction of gold ETFs. I think GLD came about in 2004, really became popularized, I want to say in 05, 06, after gold made that big move from 500 to 720. And so before you had the introduction of gold ETFs, there was no easy way to buy gold. You had to call your futures broker. You go buy it at a coin shop. There was no way you could buy it in your brokerage account. So then what did you buy? You bought gold stocks to get exposure to gold. And this even goes back to the 1960s, which I talk about quite a bit in my book, because in terms of like where markets are from a 30,000 foot view, like we're in the mid to late 1960s. Like it's a beautiful comparison. And gold stocks in the 1960s were a proxy for gold. And so I think gold right now is kind of following the pattern that gold stocks had in the 1960s. So, but getting back to more of the last couple decades, until '04 and '05, when you could buy GLD or SLV, basically, you know, any a portfolio manager or retail if they wanted to buy gold, they had to buy the gold stocks. So that was those were two reasons why gold stocks have really struggled versus gold. I mean, the gold ETFs, that's a big one since the mid 2000s. I mean, more recently it's the cost inflation, but also the other thing is precious metals have been in a secular bear market, or they were in a secular bear market from 2011 to 2023 or 2022. I mean, depending on how I think I kind of measure it from 2011 to the I think October 23. So that period is how I would measure it. That was a secular bear market for precious metals. I mean, yes, gold went sideways during that period and it went up from 2016, right? But the secular bull market, I mean, it began with the breakout in gold earlier this year. It didn't begin in 2016. I mean, because gold has not been outperforming other asset classes, really until recently. So I liken the breakout in gold to the one we had in the stock market in 1982, where the stock market from 68 to 82, it went sideways. So there's a lot of similarities with respect to that bear market and the recent secular bear market in precious metals. And yeah, so some people will say, oh, well, gold, it bottomed in 2016. But I mean, look at silver, look at the gold stocks from 2011 to that bottom in October 2023. I mean, what, they were down like 70%. That's a secular bear market. So that when you're in a secular bear, obviously the gold stocks are going to perform poorly against gold, and the silver stocks will perform poorly against silver. But uh, yeah, I had another thought, but I think I lost it. But basically, where we are here and now, what I can say about mining stocks, gold stocks, and silver stocks, they perform well because of the introduction of the ETF. So now everybody just buys GLD, or SLV or PHYS, all that stuff. Because of the introduction of the metal ETFs, the miners they're basically now options on gold. Like they're not really stocks. Like you have to consider them like an option on gold. But they're better because you can, there's no expiration. But they're really an option on gold. And so you look back over the last 20 years, the miners will outperform gold either after crash bottoms like 2008, COVID low, or when gold makes a major breakout like we just had. So I think that the miners are in a real sweet spot here. Like if let's just say this cyclical bull in gold runs another like 3 years, I would think the miners, they could outperform for another year and a half. But once you get to the end of a move in gold, like the last, 40% or 30% of that, like the miners don't outperform. So we are in the sweet spot for the miners to outperform now, but that's not going to continue permanently.
So I have been looking at some of these mining stocks for the past few years. I added aggressively in October around there, if I look correctly, sometime around that time frame. I don't want to say an exact time frame, but I was just looking at some stock prices of, for instance, Gato Silver, I am Gold, and they seem to bottom out in October of 2022. So you're saying that last year a lot of stocks bottomed out, while there may have been maybe a few stocks that have been going up since October 22. I don't know how much you've looked into that, but I've just looked into this one technical trader, David Brady. He always talks about like high beta stocks. Those are gonna like go crazy on the upside. On the downside, they're gonna get crushed. And I didn't own Gato Silver. I regret owning Gato Silver, but I regret not purchasing it. But so you're saying that a lot of stocks then bottomed out last year, then, correct?
Well, if you look at, like, I'm just looking at my screen, I'm just looking at
Yeah.
GDX and GDXJ. Like the
Yeah.
low is 20. Like, yes, you could say they bottomed. I mean, the price low was in 2022. Um, yeah, for GDX and GDXJ, it's clear. But to me, you could make, I mean, this is like semantics, but you could
Yeah.
make a
Yeah.
case. You could make a case that, I mean, for GDXJ, for example, you can make a case that the secular bear didn't really end until, February 2024.
Yeah.
For GDX, yeah, I mean, I'm looking at silver, for example. I mean, there's a clear bottom in 22, uh, October 2022, like you said, and for gold. But yeah, the way I look at it in terms of the secular trend, like it really didn't end until October, like the October 23 bottom.
Yeah. The reason why I'm bringing up October 2022 is that's when a lot of the stocks in the S&P, like the high flyer stocks, they bottomed out. And I'm thinking, okay, S&P bombed out at what, 3,500, 3,600, whatever it was. And then some of these miners bottomed out. Not everyone, like you mentioned. And if we have a secular bear, and I think we are in the process of topping out in the stock market, and whoever wins next year is going to face a tough time. But putting that aside, I'm looking at the yield curve now uninvert. That's a warning sign. And layoffs are starting to pick up, unemployment starting to pick up. And 2008, what we saw is everything took a dump. Early on in COVID, everything took a dump. And you think that gold would outperform, like, say everything is falling apart, gold stock should hold better than the S&P, you think? I mean, these are volatile. That's what I'm trying to think out loud. And that's why I have a hard time thinking that, okay, if the stock market tanks, then these will definitely tank. Maybe they will get a bid after that, but I don't know your thoughts on that.
Yeah, I think it depends on a couple of factors. I mean, if you're looking at if there's a crash, and a lot of people in the gold bug war, they say the market's down 20%, they call it a crash. Like
Yeah,
a market crash to me is like 2987, middle of 2008, like COVID.
yeah,
That's a crash. So if you have an actual crash like that,
yeah,
then yeah, gold stocks will get hit with the market. However, we have to go back in history and look at there are some periods when precious metals completely diverged from equity bear markets. I mean, people forget about there's 2000 to 2002. So that is one period when there was a divergence. Gold stocks actually bottomed in November 2000, whereas the stock market peaked, as we know, in March 2000. And so the market didn't bottom until, what was it, October 2002. So during that bear market, in recession, precious metals actually went up. Now that was more so gold and gold stocks than silver because silver was really lagging. But the other one is the period of 70, I think it was, so the bear market was 74 to 75. Or I think it was seven, no, excuse me, 73 to 74, where you had stagflation and you had a recession and you had a 50% bear market in the S&P. Precious metals actually went up during that time, and commodities actually held up fairly well. I looked at copper and the CRB during that period. And so what's really interesting is, so you had the big bear market, or you could say market crash because it was down 50%. You had the recession, but precious metals went up. And then when the economy recovered, that's when precious metals had their huge bear market. That's when gold went from like 200 to 105. So when the market actually recovered, so there was a negative correlation between precious metals and the stock market at that point. And what's really interesting is if you go back to my gold against the 60/40 chart, the gold breaking out against the 60/40, it gave us the confirmation signal in 1972. And we got, for the other secular bull, we got the confirmation signal in 2002. And I'll try and do my best to explain why this is really significant, considering um, that, considering where we are here and now. So we have not, I don't know if you can see my mouse, or maybe your mouse, probably just your mouse, but you can see that like where we are now. We haven't gotten the signal yet because the stock market has been too damn strong. But again, I'll try and explain this as best I can. So a big reason why you had precious metals diverge from the bear markets, um, again, 70, 73, 74, 2000, 2002, was because precious metals were coming out of a secular bear at the same time. So there was very little money in precious metals at that time. So there wasn't this huge amount of selling that would come into precious metals. Now, precious metals followed the stock market, I think in 70, 72, like 71, 72. They're actually moving up together, which is kind of similar to what we've seen the last year or two. So they were moving up together, 71, 72. Then you had the signal that signal from gold against the 60/40, as you can see in the chart, in 72. So when the S&P, like, let's just presume there's going to be a bear market in the next year, could be 6 months or maybe even 12 or 18 months. Let's say there's a bear market coming. Then you're very likely to get that signal. And my point is, there's not a lot of money that's in precious metals right now. Yes, we've had a big run, so money is starting to come in the last 6 months or so. But if you look at the GLD, I mean, not a lot of retail money has, the assets in the GLD are still really low relative to where gold is. So there's not a lot of money in this market that if there's this big downturn, the selling is going to come from people in stocks and bonds and not necessarily in gold. And if you have this big downturn, I mean, if you're having let's just say we have a recession that's deflationary or disinflationary, they're going to have to print shit tons of money. We all know that. And so fundamentally, we know that real interest rates are going to go much lower. So that's really, really good for gold. So the setup that we have, this is not 2008. It's completely different than 2008. In 2008, that was the middle of that secular bull in precious metals. So gold had gone up for 7 years in a row at that point. Gold stocks, silver stocks, and junior, they made huge moves. There was huge amounts of money in precious metals at that point. And so we are not close to that point yet. But I will say this, if you look at, okay, the middle of the, let's say 2008 was the middle of that secular bull. You could say a similar thing about 75, 76. That was the middle of the 70 secular bull, where again, gold declined by 45%. So and again, predictions, I mean, nobody can predict the future, but again, if we have a downturn coming in the next year or two, I don't see gold and precious metals following down with the stock market. That doesn't mean they're going to go up every day or every month. I mean, but if you look at the 70, you look at the 73, 74 period, I looked at it. The gold stocks, they skyrocketed during that period when the market went down 50%. But the Barron's Gold Mining Index, it went down like 25% 3 or 4 times. So I'm talking about the big picture here. But I don't see, like, what I could see is you have a recession and precious metals have this they're in a cyclical bull, secular bull as well. They have this great big move over the next couple of years, uh, but then you don't get the based on. Let me step back for a second. Based on what happened in the 70s and the 2000s, where you have this big decline in the middle of the secular bull, we could very well get that again in gold. But I don't see that happening until, the end of the decade. Maybe it's in 2028 or 2029 where gold has gone up, silver has gone up a huge amount, but you have some kind of a big crash and precious metals really get hit at that point because it would be the middle of the secular bull versus now where it's just at the beginning. So I know that was a long, diatribe and word salad, but there's quite a few differences in 2008. So I really don't see precious metals being taken down if there's a recession and downturn in the next year or two. However, I do think that will happen by the end of the decade.
Yeah, I'm just thinking, I look at stocks, like over the last few months, they've been very volatile. And especially the day that the yen carry trade unwound. And when I saw that, gold initially was higher, the miners were higher, but then everyone had to meet margin calls, all these big wigs, and they ended up selling their good positions, which are gold, in my opinion. Everyone tried to raise cash. That's what I think may initially happen when everything collapses. Okay, bonds rally, I could see that happening. And then gold initially rallies and then sells off. And then they announce some sort of infusion from the Federal Reserve. They're going to, like you said, print more money to artificially lower interest rates. And then you see the 10-year TIPS yield goes negative, temporarily speaking, but then it'll go positive once the whole system unwinds. That's what we saw in 2008. That's why gold took a dip. That's what I see happening, but I do think that gold and silver will outperform the S&P 500 over the next year, year and a half, even if we see a blow off top in the S&P 500. I don't know if you see it that way, but that's what I'm seeing based on a bunch of technicals and fundamentals. So,
Yeah, I mean, I'm not, every bear market is different, so I don't
right.
see like I just don't see a 2008 type thing happening in the next year or two. I could see that happening at the end of the decade, and we're too early. We're too early in this move in precious metals where for there to be a huge decline like 2008. I mean, gold just, just it's only 6 months or 7 months into this breakout from this 13-year pattern. So this is a completely different situation. And the other thing is the psychology. Like that's what everybody thinks. Like I see on financial Twitter, I get emails from subscribers asking this question all the time. Like that, it's I don't like it when people say, "Oh, well, everybody thinks this is going to happen." Everybody says that because there's no way to document that. But that's just my sense is like everybody is really convinced the average, let's say the average conventional or normie, as your buddy would say,
Normie.
the normies, yeah, the normies out there. Well, let's say the normie professionals. Yeah, they think, yeah, I like gold, but I'll buy it after the downturn or the recession. But this is there's so few people saying what I've been saying. I don't know. Maybe there's a few people who have said that. That's not to say that like I know better than all these people, but I just think the contrarian position is that no, there's not going to be a 2008, and during the next downturn, precious metals will go up like they did in 01, 02, and 73 and 74. To me, it's just too many people they're programmed they have a recency bias with respect to 2008 and COVID as well in 2022 when the Fed was hiking, because that was a bad year for gold and the stock market. So that's, yeah, I mean, that we'll see how it plays out, but that's generally my take is I don't see that happening until the end of the decade.
Okay, sounds good. Before I let you go, Jordan, where can people follow your work?
They can follow me at thedailygold.com. They can follow my YouTube channel, my website that I already mentioned that. Um, can email me, Jordan at thedailygold.com. I have a free report on my website, a free company report. I'm also editing my new book, so that should be done in a couple weeks. So get on my email list and you'll get a copy sometime in the next month or two when that's ready.
Awesome. I'll definitely take a look at that. Thanks again, Jordan.
My pleasure.